What's up, good people? Welcome back to another weekly recap with me, Christopher from Better Today Trades, where we focus on getting 1% better each and every day and watching that compound over time. So this week for the weekly recap, I kind of wanted to do something different because the last couple of recaps I have been voicing a bearish sentiment for the near term. I've been saying until about October, and I want to show you guys why I have that view on seasonality. So without further ado, let's get into it. So as you can see here on the screen, I have the VIX chart. Now the VIX chart is just a volatility index. This shows it's actually the relationship between put and call options. When there's a lot of fear in the market, people will buy puts on the SPY to go ahead and hedge for the downside, just in case there's any crashes, corrections, pullbacks, anything like that. And what I noticed is doing my analysis that every year from about August to October or August to December in some cases, you see a volatility spike. So what I did here was I went through each year from the August low on the VIX into the peak of the spike until the end of the year. And I measured the percentage from the August low on the VIX to the peak for each year. As you can see, some years it was just one bar, which these are the monthly bars. So this was 1 month, this was 5 months, this was 5 months, this was 1 month, this is three months, 3 months, 5 months, all the way back to 86. This goes all the way back to 86. Now, in order to see it, it is kind of tough to see here. So I did go ahead and take this information and put it onto a spreadsheet for you right here. So as you can see on this spreadsheet, it goes all the way back to 86, and it shows you the percentage from the August low to the VIX peak and the number of months it took to get to that peak. So you can see in 86, it was about 2 months, about 82% change from the low to the high. And then you can look over here and see that the median for all of these years from 1986 to 2022, from the August low to the VIX peak into the end of the year, it was a median of 3 months and an average of 3 months time span. And the median percent change was 82%. And the average percent change is 127%. And as you can see, I also did the median and the average for what I call the outperform average, where you can go ahead and see, all right, if it's going above 127, basically, you can see a 210% spike or a 309% spike, depending on the median or the average that you're using. So with that being said, I wanted to go ahead and mark out what that would look like for the year 2023. So I've got here, this is the year 2023. This is the VIX on a monthly chart. Now this would be an 82% move from the August low would put us at a $25 VIX. A 127% move, which is the average that you see from on a VIX spike between August and the end of the year. So if we had an average spike in the VIX, we would see a $31 VIX within the next 3 months, or two months now, because we're basically in September as it is. So these are the two levels that I'm looking for the VIX to spike to before we see this sort of correction in the market subside. So we're still early on, basically, is what I'm saying. Now let's see. I will also show you what it would look like if we had a little bit higher of a spike. So these are the 82. This is our bull case, I guess, bear case, and then it gets even more extreme. So as you can see these two, $25 VIX, $31 VIX, that isn't too extreme. You can see those pretty often. But I've taken the time to go ahead and show you what happens, where would we be if we saw an outperform VIX peak. So let's say it takes us 5 bars and the VIX peaks out at 211% from the August low. You would see a price of about $42, $43 for that VIX. That is extreme panic. And if it was a 310% spike from the peak, from the low to the peak, you would see a $56 VIX. And just to put this into perspective, I want to show you the historical VIX and just go ahead and show you what would have to go wrong for us to see a 42 or a $56 VIX. So every time you see here that the VIX got above this 42 level, I've marked out what was in the headlines at the time. So you got COVID that spiked us up there. You got an inflation scare, which, I mean, we are going through inflation. Is it over? Is it transitory? Are we done? Are they going to keep hiking rates? You got the flash crash. You got a debt crisis, another flash crash. The global financial crisis is what got us above the 56 level here. COVID got us above the 56 level here. This one, just general panic. So, I mean, it could be not much that's going wrong and get us to a 42. This is 9/11, got us above 42. This was a worldwide recession scare, which people are forecasting a worldwide recession on the horizon. So that could get us up to 42, above 42 as well. The Asian market sell-off back in the 90s when everybody thought Japan was going to be the next big economy, and then that didn't pan out. We've got the junk bond crisis here. This is back in the 80s, late 80s. Black Monday, of course, the worst day in the markets as far as volatility is concerned. This one went up 900% from the August low, completely outsized. It'll be difficult to see that again. But as you can see, to get us to 56, it takes something major. We got the GFC, we've got the COVID, and we've got Black Monday are the only 3 times in the history of the VIX that we've seen a VIX above 56. But it's possible. That just shows you it's possible. So, all that being said, what I'm looking for in the VIX, like I said, is a $25, a $31, and if things look like it's about to fall apart, I'm looking for a 42 VIX. But like I said, it could go to any of these numbers. But I am expecting a spike in the VIX between now and the end of the year. I would assume it would happen by the end of October. Typically, judging by historical data, it would happen by the end of October, but it could happen any time between now and the end of the year. So that's why in my last recaps, I've been saying I'm expecting the SPY and the Qs to pull back, the indexes to pull back, because this is typically the worst time in the market as far as seasonality, as far as time of year is concerned. So I just wanted to show you guys exactly how I came to that conclusion and why I'm looking at what I'm looking at. Because, you know, a spike in the VIX typically coincides falling prices, especially for the indexes especially. So that is our weekly recap. It's the 26th of August. Let's see what the next week has in store for us. Peace.